Welcome to myfinanceteacher.org, and let's have a look at some of the most interesting markets at the moment. Let's start with the US dollar. As I mentioned in one of the previous videos on gold and US dollar has started a new intermediate cycle over here in the middle of January. Even though the previous correction down into the intermediate cycle low was relatively mild based on the usual duration of these cycles, it's time to start a new one. And although a couple of weeks ago I expected the US dollar to mostly go sideways, it's actually increased, perhaps in expectation of a Fed rate hike and as a bit of a safe haven while the stock markets have dropped with tensions in Eastern Europe. The daily cycle is 49 days old, and usually these daily cycles on the US dollar last for around a couple of months. So perhaps a bit higher on the US dollar into that mid-March FOMC meeting, although not significantly higher highs, as it's already poking a few times above relatively wide Bollinger Bands, and the US dollar is starting to enter into overbought area. The previous time the US dollar entered into overbought area, it didn't really stay there for too long. So perhaps just another few days up before coming down into the short-term daily cycle low, perhaps over the next 3 to 4 weeks. And this agrees with the Optimism Index on Euro. Euro accounts for over 60% in the DXY calculation, so we can look at Euro optics as a proxy for the optics on DXY, on the dollar index. And as you see, the Optimism Index on Euro is pretty low, so perhaps a bit of a bounce in Euro is upcoming over that next 3 to 4 weeks, as I mentioned. And of course, a corresponding drop into the short-term daily cycle low on the US dollar. Next, looking at gold, I think the opposite is likely on gold. The daily cycle is 35 days old. And yes, gold has actually rallied a bit further than I expected. I thought gold would show some volatility somewhere around 1920. It's close to 1950. But coming up to that FOMC meeting in mid-March, the daily cycle will get close to nearly 2 months long. Usually these daily cycles on gold last for somewhere between 1.5 to 2.5 months. We see gold is poking above a pretty wide Bollinger Band, and if there is any sort of a decline in the tensions in Eastern Europe, that would have a potential to bring gold down quite noticeably, perhaps at least down to the previous intermediate cycle high somewhere around 1880, and that's where we see this pivot at the end of February as well. But that's only the short term. The intermediate cycle on gold is still pretty young. So far it's only 79 days old. Usually these cycles last for around half a year. And given that the previous 2 intermediate cycles on gold were relatively short, perhaps this one will be relatively long to keep the average somewhere around half a year, meaning that we perhaps still have quite a lot of time for an intermediate cycle rally in gold before it has to come down into that intermediate cycle low at the end of the cycle. Looking at the Optimism Index in gold, it's at 65. So in the intermediate term, we still have quite a lot of space before everyone gets somewhat a little bit too excited about precious metals. So to reiterate, a bit of a risk over the short term into that FOMC meeting, but after that we should continue the intermediate cycle rally. Next, looking at crude oil, I think there are considerable risks in crude oil. It's reached the long-term resistance from some of these multiple highs in early 2012 and mid-2013. That's just above $110, somewhere around $115. So crude has actually even reached this resistance from early 2011 as well. And clearly tensions in Eastern Europe do add considerably to higher prices in energy. But as I mentioned, there is a risk of significant drop if there is any sort of de-escalation, any sort of prospects for a resolution of the crisis. Looking purely at the technicals, the intermediate cycle is 92 days long, and usually these cycles last for just under half a year in crude oil. We see crude oil has poked a few times above a relatively wide Bollinger Bands, so together with myfinanceteacher.org, relatively recently we've been reducing our allocation in XLE. But in the very long term, I'm still bullish on energy, so we'll be looking forward to reaccumulate our positions in XLE after some sort of a correction in crude oil. Looking at a bit of a longer term view over here, we see crude oil has already skyrocketed quite significantly from early 2020. And although over the next few years, and I'm still very positive on energy, I think perhaps it's likely to either cool down significantly or go sideways a little bit to come down from its currently overbought levels, even on weekly as well as on monthly charts. We see the monthly 14-day RSI is at 71.6. Looking at Optimism Index, we see a bit of a negative divergence in Optimism Index where price in crude oil is making significantly higher highs, while the Optimism Index is making lower highs over the last several weeks. We see that from early January into yesterday, lower highs on Optimism Index, and we see similar behavior close to the tops of the previous 3 intermediate cycles in crude oil. Every time crude oil is approaching its high, the Optimism Index starts to diverge with relatively lower highs. Another very interesting commodity at the moment, in my opinion, is copper. For quite a while, I thought that there was a 60% chance that the intermediate cycle in copper was still ongoing all the way since mid-August. And yeah, there was a bit of a dip in mid-December, and I thought that there was a 40% chance of the dip in December also representing another intermediate cycle low, giving us a relatively short intermediate cycle lasting for only 118 days. What happened more recently, we see copper at significantly higher levels, which means that unless copper drops all the way back down to new lows below $4.2 over the next couple of weeks, there is a pretty good chance, I would say a 70% chance, that we saw a relatively short previous intermediate cycle finishing in mid-December, meaning that this new intermediate cycle in crude oil is now only 79 days old, and usually these last for around half a year, although the duration varies quite a lot from a minimum of 111 days to a maximum of 243 days since May 2017. So now with this new outlook on the intermediate cycle, the potential in crude oil is quite significant. Together with the members at myfinancesteacher.org, we had been holding copx positions even with only 40% expectation of this scenario playing out. But now that copper has shown to be in a relatively young intermediate cycle, I would like to take a chance to increase my allocation after perhaps a bit of a cool down in the short term. If we zoom out, we see copper is close to a couple of previous intermediate cycle lows. It's even approaching the high from May 2021. And before that, copper has rallied quite significantly from under $2 to over $4.8 in a year and a half. So, of course, after such a significant rally, as I've mentioned multiple times to the members at myfinancesteacher.org, you would expect some sort of a consolidation, and perhaps copper is ready to break out of this consolidation box. So if this consolidation box still provides some sort of a resistance, if copper is to cool down in the short term before breaking out, I would like to reaccumulate more of the copx positions, somewhere around the middle of the Bollinger Bands. Let's see how it goes over the next few days, and for more detailed updates, make sure to join us at myfinancesteacher.org. And lastly, let's have a look at the general stock market. I think we are in a new intermediate cycle beginning from late February, but again, with tensions in Eastern Europe continuing and perhaps with the upcoming potential rate hike at the FOMC meeting in mid-March, we might see a bit of a cool down again in the general stock market before the rally continues. But again, if you zoom out, you'll see that over the last couple of years, the general stock market, S&P 500, has more than doubled, and similar to the comments on copper, perhaps it's time for the general stock market to consolidate a little bit, perhaps in a bit of a consolidation box, especially with crude oil so expensive right now, with inflation pretty high, damaging a lot of consumer confidence. The ongoing new intermediate cycle might not actually give us any significant rally. So you got to be careful where you want to get out of your long positions. And again, for more details on that, join us at myfinancesteacher.org. Let's just have a look at the Optimism Index on the general stock market. And we see that Optimism Index is pretty low. And back in late February, it was at the lowest levels since that pandemic drop in March 2020. Meaning that, yes, there is a pretty good chance we've seen the low and the stock market is likely to climb up into the top of this consolidation box with perhaps a bit of a softness into that FOMC meeting. And lastly, looking at the smart money and dumb money confidence, where blue line is the smart money, we see that late February, the smart money confidence was higher than it was back in December, meaning that it was at the highest levels again since that pandemic drop in March 2020. which is a good sign, smart money being confident, as you generally want to follow the smart money. And the red line is dumb money, retail traders. Again, the retail traders back in late February were at the lowest confidence levels since pandemic lows. And as you usually would like to avoid following the dumb money, perhaps that is also a positive sign for the general stock markets. But again, that's perhaps in the short to intermediate term, and you might want to be pretty quick with taking your profits. But again, that's only my opinion. Nobody does actually know the future, so let me know what you think in the comments below. Let's try to learn from each other. I'll try to respond each of your comments, and I would really appreciate it if you hit that like button and subscribe to the channel if you haven't. Have a nice weekend. Bye-bye.